Well, welcome back, everyone, to a episode of Compound Thesis. Our guest today, super excited, it's Leigh Drogen. He's the general partner and CIO at Starkiller Capital. How's it going, Lee?
Awesome. Thanks for having me.
Yeah, so would love to dive in. You and I know each other from a previous life, and would love to, for the audience, get a little bit about your background and tell us what made you start investing in crypto.
Yeah, I started my career in equity stat arb at a hedge fund in New York, running mostly momentum and event-driven models, and just fell in love with markets. I then spent about 15 years in fintech or so. First at a pretty nascent fintech startup, and then I left to found a company called Estimize, which I ran for about 10 years, venture-backed company that was acquired back in 2020. Um, I got involved in crypto back in 13 when I bought some Bitcoin, just to kind of understand what it was, because I like playing around with new tech. And my initial thesis was that, after owning some for a little while, that this stuff was just religious proselytization as a financial asset. Like, if you could own a digital religion, is that a good investment? Yeah, probably. Like, it has all of the pieces of what you would want in an asset that you would want to appreciate. And so I bought more in 15. And then in early 17, I'd say the thesis, started to change a bit when the Ethereum ecosystem really got going. And I really dug deep into, what was this actually going to be about, in the long run? Was there going to be real utility here instead of just this digital gold rock thing that didn't really do much. And I got really excited at what was going on and felt like there was going to be very real utility down the road. And so I actually sat down with a friend of mine at that time who runs a pretty large quantitative equity asset manager. And we had this hypothesis about the crypto markets. And it was basically that because there's was and still is very little intrinsic value to these assets. And I don't mean that in a derogatory way. I mean it like, there is yet to be a kind of fully decided way to value these assets with such high convexity, because they can scale so quickly, the users scale quickly, the TVL scales quickly, the technology changes so quickly, it's global, that you get these huge kind of bubble and bust cycles. And what we felt was that if we looked, we would find there was a huge kind of momentum characteristic to the market. And so we took the classic kind of CTA style trend following and momentum models from equities and commodity futures markets, and we applied them to crypto. And unsurprisingly, what we found was a lot of alpha there in those models. In using the trend following models to keep you from having to take 80 or 90% drawdowns as these bust cycles happen. And if you look at the momentum cross-sectionally, meaning just look at the relative strength, what we found was that if you knew nothing about these assets whatsoever from a fundamental perspective, if you didn't know the difference between Ripple and Qtum, that you could accurately pick assets that would outperform the basket or outperform Bitcoin or ETH, without knowing really what they were. So I got really interested in it from two perspectives. One, the actual trading, and two, the technology. And that's really the genesis of what we do here at Starkiller and my interest.
Great. So, like, how can you give us a little bit more on Starkiller? Like, how long has the firm been around, and what type of tokens or projects do you guys typically invest in?
Yeah. So I wanted to start this fund back in 2017, but because I was running a venture-backed fintech startup, doing those two things at the same time wasn't really possible. So I had to put that on hold. But I was trading my own book with this stuff, and when the company was acquired, I got the chance to go do it. So we started the firm. I started the firm with a friend of mine who I've known for a very long time, Megan Hannum, who's my partner and COO. And we started it in August of 21. We launched the firm to investors in October of 21. And so we've been trading since then. And the firm is basically a liquid token, risk managed, momentum and trend following type book. So we're operating in the liquid portion of the universe, which it ebbs and flows. Back in 18, there were only really 15 liquid tokens. At the height of the liquidity in January of last year, there were a good 700 liquid tokens. Today, there's more like 200 liquid tokens, 250 liquid tokens or so that we can trade. And we operate on every chain, all assets, and the model is basically what we call a quantamental model. So we're not a fully systematic book. What we do is we run a bunch of quantitative models that span pure price and volume, and as I said, that's mostly momentum and trend following type stuff, to all of the fundamentals, and what we're really looking for is the second derivative of growth in the fundamentals. So how fast is adoption of a specific protocol or chain taking place? Because we find over the mid and long horizon that that really is one of the big determinants of the directionality of price. And so we kind of mold these two things together, both the, what you would call the quantitative, price-based stuff and the quantitative fundamentals-based stuff. And it all ends up on a factor dashboard for me every day. And then we dial up and down the risk according to our trend following models and the asset selection, where we'll never really have more than 20 positions at a given time. And that would be a lot for us as well. The asset selection is largely based on those cross-sectional momentum models, and then the fundamental kind of overlay on top of that.
So as you look at, your experience prior to coming to cryptos, traditional asset classes, equities in particular, when you look at SMIs, what are the differences in, just structurally crypto versus, traditional equities, long short equity funds? Can you talk through any of the, kind of idiosyncratic, differences in crypto that, you face that are opportunities or challenges?
Oh man, so many. So the two kind of biggest things that I always remind myself of and remind my team of, and when we have conversations with potential investors, one is that crypto is the dumbest asset class in the world. And I say that with complete love for what's going on, but it is the dumbest asset class. Meaning, and I'm sure a lot of listeners will recognize the midwit meme, where it's, the normal distribution of IQ. And the goal of crypto, investing in crypto, is just never be the midwit. Never think that stuff matters more than it does, and that the dumb part of the industry won't absolutely dominate the kind of midwit thinking of this has to have fundamentals, or this can't possibly go up more, or any of those things. Where in equities, you have to assume that almost everything is priced in. You have to assume the market is incredibly efficient, because it is, because you're playing against the best in the world. You are playing against the smartest people in the world, and they have honed their craft over, decades and decades here. In crypto, you are not necessarily playing against the smartest in the world yet. At some point, you will have to. And the market is not efficient in any way whatsoever. The things that you think are priced in are likely not. And so you have to, if you come from that TradFi background, you have to almost dumb it down, that piece of your brain that says that alpha can't possibly just be sitting there. But often it is. And you really have to dumb your brain down a little bit to pick it up. The other thing that we constantly kind of reiterate about crypto is that it's just like any other market, but more so. It's more volatility. It's more insider trading. It's more fraud. It's more just shenanigans. It's more momentum. It's more growth. It's just more of everything that you would traditionally get in other markets. And so one of the things that you have to do as a PM coming from TradFi is you have to recalibrate your risk tolerance. You basically have to be willing to see your portfolio move around a bit more every day when you do have risk on. than you would in TradFi, where, if your portfolio is moving around 2-3%, it's kind of it's a big day. But in crypto, that would just be a very normal day. And so you just have to recalibrate, because if you come in and you keep that same calibration, you will get whipped around really, really hard. And so you just need to give it kind of a wider berth.
So you mentioned there that, the bigger asset managers, the more sophisticated folks that have, honed their craft in equities or commodities or other asset classes are not in crypto yet. What do you think it is? What will it take to unlock, that real institutional capital coming in? Is it, regulation, market structure, liquidity? Like, where do you feel, or is it all the above?
It's all the above. So we'll talk about the paper that we published a couple of weeks ago, where we go over some of this. But I have a lot of friends from that world that, as do you, and I talk to them on a regular basis. Some of them at really large hedge funds that want to be involved, and I constantly take their temperature about it, because I think that's a, potentially really good signal, longer term. And it's basically all the above. So one, they have a really hard time with the regulatory aspect of it. Right now, 80% of volume is on Binance. And if you have beneficial owners of the GP that sit in the US that are US citizens, you can't get a Binance account unless you really rig up the structure of the firm so that it's offshore and there are distances between the GPs and the fund itself. And you got to do all sorts of things in order to do that. So they have problems getting the necessary liquidity at the size that would make sense for them. The other thing that they're thinking about from a regulatory standpoint is, if the SEC wants to come down on some aspect of, unsettled regulation, and this is, as we know, how, they've been dealing with it. They don't tell you what is kosher and what's not. They basically just come after you when they decide that they want to. It's too late, right? Which ain't a great regulatory framework, but it's what we've got right now. So if you are a large hedge fund, you really have to know that you're on the right side of the line at all times, no matter what, like beyond a shadow of a doubt. And some of these things, like buying and selling certain assets, securities on certain protocols in DeFi, or operating on Binance, or any of this stuff, puts you in the crosshairs, because the SEC is not coming after a $100 million fund, right? They're going to come after a $10 billion equity fund that is well known to make a point. They have a history of attempting to make a point with, very public figures in this stuff. So that's a big issue for them. The other one is, it's very hard to short in crypto. So a lot of these firms, they're not long only firms. They're mostly market neutral type firms. And I mean, good luck getting enough size on the short side. And even if you can get enough size on the short side to be delta neutral at a big size book with leverage, you are now exposing yourself to incredible counterparty risk, because again, 80% of that volume's on Binance. And even if you're trading against some of these other OTC counterparties, there's just an incredible amount of counterparty risk right now.
Sure. So one of the things that you said earlier is that, fundamentals don't matter, at least at this moment in crypto. I mean, there's a lot of data out there, right? You could see, TVL, you can see developers, you can see all these kind of like fundamental unit economics or drivers that you would imagine would be, correlative to the price of a particular token. Do you think that evolves and matures, and at some point in time, those type of factors matter more so than what the market structure is doing now, which is more momentum and hot ball of money based?
Absolutely. I just think it's going to take many years here. And eventually this market will end up trading similar to other TradFi markets. Our thesis right now, and this probably is the case for the next 5, 7, 8, maybe even 10 years, depends on how long it takes for real businesses to seriously be built at scale on these things. But the thesis is basically that right now the investors in crypto are investors that are here for the huge convexity of the asset, meaning they're not looking for a 30% return, right? They're looking for a 400% return over, a number of years. And because of that, what we find is that basically they hop from protocol to protocol and theme to theme, and this is what produces this kind of hot ball of money. The only way, or when we get, real fundamental trading, it's going to come about for two reasons. One is the overall growth of the asset class declines to the point where there isn't the incentive to just bet, on huge appreciation of the asset because of adoption curves, which is what's going on right now. And two, you need the stat arb hedge funds to come in and be the buyer and seller of last resort at two ends of a valuation spectrum. Right now, that doesn't exist at all. We wouldn't get 90 to 95% declines in all of the altcoins, every 3 years or so, if there was a buyer and seller of last resort at some reasonable range of, valuation based on fundamentals. When that happens, you will find that the vol will decrease. These big trend following kind of based moves over a 6 to 18-month period will decline as well, and the market will become a little choppier, and we won't have these massive drawdowns. But we think that that's going to take a while until there's mass adoption globally of these assets, and then the businesses as well are more stable. They're not just like Series A and Series B tech startups, which is basically what everything is right now at the end of the day. And then real investors fundamentally are there to put a floor in things, but also put a ceiling in things when they get out of whack.
Sure. So you threw out 400%, so I'll anchor myself to that. But in terms of target return for funds that are in this space, like how do you think about, for your investors or for your process, like what is the benchmark that you evaluate performance against? Like, are you generating alpha against BTC, ETH, a basket of cryptos? Like, what's the right and wrong way to evaluate active management in this space? Aside from just an absolute triple digit target return.
Yeah, it's a great question, and then I'll throw in something at the end, which kind of maybe makes it besides the point, unfortunately. So for us, we use Bitcoin as our benchmark for a couple of reasons. One is there is no real kind of liquid index that you can invest in. At some point, maybe there will be, but no investor, none of ours, and that encompasses fund of funds, institutions, high net worth family offices, high net worth individuals. None of them are able to do that. And so it doesn't make any sense to, try and peg yourself to one of those indexes that isn't liquidly traded and nobody actually uses. So that's one. Bitcoin is still the asset that people say, well, if you can't beat Bitcoin, then like, why am I giving you money? Right. Because that's just the easiest thing for them to go invest in their Coinbase account. They could do it in size, it's liquid, they get a little bit of yield on it, et cetera, right? I think there's a good argument that it should be ETH at this point and not Bitcoin, but I mean, frankly, it doesn't really matter that much. We do, though, internally judge ourselves to a different standard than our marketing material or what we talk about with our investors and things like that. What we judge ourselves is really against two things. One is we have an equally weighted, basically an equally weighted portfolio of all the liquid tokens in our universe. And so if you rebalance that weekly, we follow that index, and can we beat that index? The second thing that we judge ourselves against is if you took a really simple incarnation, and we actually talk about this in our paper that we put out. If you took a really simple incarnation of a 550 exponential moving average crossover on top of Bitcoin as a signal to go in and out of cash for a portfolio of purely the cross-sectional momentum model, the top quintile of that cross-sectional momentum universe, meaning every week you rebalance into the tokens that are basically the top fifth of the
Running the hottest.
yeah, running the hottest basically. And we judge ourselves against, like, can we beat that, right? Because if we're not beating that, then we might as well just run that model fully systematically and like save a lot of time. We have been able to do that, which has been great. But that's really internally the one that we peg ourselves to.
Probably hard to explain to your everyday investor that wants to get exposure to this space, except for the like really sophisticated, family offices and fund of funds that like really understand the space. But really good color. Before we dive into your paper a little bit, just like talk through your process a little bit. I know you said you kind of wake up every day and you have that dashboard of a bunch of different signals. I mean, things are flying around 24/7, so you must never sleep. And I'm sure that that's not at 8 a.m. when you drink your coffee every day and look at that dashboard. Like, what kind of inputs do you have that go into like inform your different positions, and how do you stay on top of all this?
Yeah, because of the vol, the key for us, at least in what we do, is to try and do less.
Mm.
It's make decisions on a um, less frequent basis. Because if you're making more decisions on a more frequent basis, you're again going to get whipped around. So what we find is that behaviorally, the best way to execute the types of strategies that we run is to really operate on kind of a weekly type turnover basis. So we try not to do asset selection on more than a weekly basis. In terms of the beta exposure that we have, we do manage that more kind of intra-week. And we won't take our beta exposure from 0 all the way up to, let's say, a beta of 2.5 or 3 to Bitcoin, which at some points we have. We won't do that overnight. We'll do that over the course of 3, 4, 5 days. And it's the same thing coming out of the market. When our models start to flash the fact that we should start to withdraw beta exposure, it won't be one day that we just, in an hour we get out. This will be kind of a process of, a number of days. In terms of what I pay attention to on a daily basis, a lot of it is on that dashboard, the fundamentals. And then a lot of the time that I spend, frankly, is digging into the narratives and actual fundamentals and stories behind what's in that top quintile of either the pure price momentum or the fundamental momentum, and where those narratives are and how the market's feeling about those narratives and what's actually pushing on them and things like that. And then obviously we have to pay attention to some of the macroeconomic stuff and manage risk and sometimes hedge around those events. We've got FOMC tomorrow. When markets are really extended, and let's say we've made a lot of money and the market is really overbought, and we're heading into one of these kind of event risk situations, we may hedge the book. And the same thing, maybe when there's been a really huge puke in the market and maybe we don't have any exposure and we may want to buy some blood and there's, event risk in there or maybe a catalyst. So, I do have to sit in front of the computer for things like tomorrow and kind of look at how the market's behaving during those times.
I'm sure never a dull moment, especially, the market that we've been in for the last, couple of months, to say the least. So let's go to that report you guys just put out, Cross-sectional Momentum in Cryptocurrency Markets. You guys went through and did a whole bunch of analysis, which you described as a short-term momentum anomaly. How does this, kind of work across you touched upon it a little bit, for your trading strategy, but like, how long do you think that this regime will last? And, what kind of insights can you share from that research?
Yeah, one of the goals when we started the firm was to produce research kind of in the style of AQR, which is a really famous and well-run quantitative equity hedge fund run by a guy named Cliff Asness, who's kind of a hero of mine. And they've produced a lot of research over the years that they put out publicly. And none of it has arbitraged away their ability to operate in the space and produce alpha. And so, in that vein, we wanted to do something similar. And we hadn't seen anybody really produce a solid paper looking at cross-sectional momentum that was actually tradable in a practical sense. So what we did was a serious additional amount of work on top of our data pipeline that we already had to really fill up our database with literally every liquid token that wasn't a stable coin or a rebase token or any kind of stuff with weird attributes, so that we could look at the entire market, the entire liquid market. And we wanted to produce a paper that was really easily understandable, that anybody could read, and that anybody could actually use in a practical sense. And so what the paper goes through and finds is basically that the the coins that perform best over the previous 30-day period tend to perform best over the subsequent 7 days. And if you rebalance that group of tokens weekly, and you basically buy the top quintile of those tokens based on pure price momentum, and this is only stuff that's traded on at least one centralized exchange, like reasonable centralized exchange. So we whitelisted a bunch of exchanges, at least one centralized exchange, and then it can be traded on as many decentralized exchanges as you want. And so again, you get kind of, anywhere between at the beginning of the time series period that we look at in early, I think it's 17 or early 18, you get like 20 tokens, and at the height of it, you get 600 or something like that. But if you do this, you just produce a ton of alpha and great returns. If you can stick with it and do this, somewhat systematically. And we run through that, and then we run through looking at using that trend following overlay that I talked about and seeing how that, increases performance. And obviously it does quite a bit. But we go into in the paper a lot of the hypotheses regarding why this momentum anomaly exists and why you can take advantage of it. And I think our basic premise is that, the market is basically a hot ball of money, that there's not a lot of efficiency to it, that there's a lot of, backroom, maybe illegal insider trading stuff that happens, that there's a lot of convexity to the assets themselves in terms of their growth. And all of these things should continue for, we think the next 7-10 years, something like that. But at the end of the day, I think it's really interesting that it's not that hard to take advantage of this if you simply are willing to not get married to the fundamentals of any one of these chains, because the market does not treat them as if any of these things has any long-term future. They wouldn't be down 95% or 90% if the market did believe that they had some long-term future. So at some point, one of these chains, and protocols, sets of protocols, will come along and likely consolidate the market, and kind of edge out a lot of these other chains and protocols. And then, we will have a much more tame market where you probably won't have as much momentum.
Yeah, I mean, hopefully that, coupled with the fact of regulation to stop some of the backroom dealing that you're alluding to, as well as more sophisticated managers, as we talked about earlier, getting in, so that there is that ceiling and floor kind of put in place from the folks that are keeping it within the rails of fundamentals over time, but certainly not there today. An opportunity for you, and kudos to you, kind of in the ethos of this whole space, open sourcing some of that research to share with others, to not get in their own ways as they're kind of thinking about trading and participating in this, from an asset class perspective.
Yeah, I mean, one of the big learnings, it really is simple, but it's hard to internalize, is just don't buy coins that are going down. don't buy coins that are going down. It's really it's a very simple but difficult maybe thing to grasp, because people want to believe, oh, it's down a lot, right? So I'm going to buy the value there. There is no value in crypto. It's just don't buy coins that are going down.
So the falling knives are sharper in this space than they are in other asset classes, yes, at least at this stage. And exactly. Does it work the same way though? I would imagine that, momentum is equally as effective on the upside as it is on the downside. Is that fair?
It is, although we do find more alpha in staying away from the things on the downside. So when you look at the way that you know that there's a real serious anomaly is the spread between the top quintile and the bottom quintile. So how is the top quintile of momentum performing relative to the bottom? And there's a just massive spread there. But the other question is, how is the top quintile performing relative to that equal weighted basket of all of the tokens versus the bottom quintile, relative to the equal weighted basket? And there is more spread between the bottom quintile in the equal weighted basket than there is between the top quintile in the equal weighted basket. So again, a lot of investing in crypto is just stay away from the things that are going down.
Good advice to share. I think we're kind of at time, but next time we get on, we'd love to kind of pick your brain a little bit more about how you're actually putting some of these trades in place, and the different venues and protocol, exchanges, and what the infrastructure looks like behind the scenes of all this. But really helpful to tap into your brain as somebody that's putting this in practice, running a fund and thinking about the different investment strategies that can be deployed in this space. And really appreciate the time. Any closing thoughts?
Yeah, if people want to read the paper, you can just go to Starkiller.capital and head over to the Insights tab, where once in a while we'll publish some research there. No, I appreciate you having me on.
Yeah, we'll put a link to that as we send this out to the audience. And actually, one last question: where did Starkiller come from?
So there's an academic paper, a fun academic paper that was published, it was like 8 or 9 years ago. I don't remember which journal it was in, but it actually looked at how fund managers named their firms. And they found that more warlike names tended to both raise more capital and outperform their peers. I can't tell you why that is. There's probably some kind of causal relationship. The paper didn't really have one in there, but I'm a Star Wars fan, so we wanted to pick something that was memorable and warlike, I guess.
That's great. Yeah, so nothing that starts with blue or black, as most funds, whether they're
no trees. Yeah, don't name it after a tree or something like that.
Exactly. Awesome. Well, thanks for doing this, Leigh. Thanks everybody for joining. Subscribe to Compound Thesis on our YouTube, Apple, or Spotify, and we'll have all of our episodes available at youtube.com/@compoundlabs. And we'll be back in another week with a great episode. Thanks again, Leigh.
Thanks.